Now, yesterday we heard from Moody's on the banking space, and today we heard from Fitch. Saswata Guha, the director of financial institution Fitch Ratings, joins in on the phone line from Mumbai. Mr. Guha, hi, thanks very much for joining in. Can you start by telling us what is your expectation in terms of stressed assets, in terms of a formation as a percentage to loans for FY16 versus FY15, and do you expect a further improvement, say, in FY17?
Right. Thanks for having me. Yes. Well, as we said, our expectation is for the overall stressed assets ratio for the system to narrow slightly from where it was in FY15. So in terms of numbers, that expectation is likely to go from 11.1%, which was as of end March 2015, to around 10.9 as of March 16. As you can see, the moderation is only is only slightly, because we feel that within that obviously there will still be some amount of NPL pressures. I think incremental names are the pace of incremental names have certainly slowed down, but what we're seeing is that the slippage or the mortality rates from the previously restructured loans is now increasing across banks. So NPL pressures will still be there to an extent. However, now that the restructured thing is behind us, we expect to see some degree of contraction in the restructured loan book for the system as a whole. But clearly, I think the pressure points, while lower than what they used to be, will certainly remain for at least one more year.
Okay, if you look at the Axis Bank results, they guided for 5,700 crore of stressed assets for the year, and already in the half year they've reported nearly 5,000. On the PSU bank space, we had a bomb in terms of Indian Overseas Bank. So what gives you this confidence?
Well, of course, there are issues with individual names, but what I'm referring to essentially is from the system as a whole. As far as Axis is concerned, we've always believed that the potential of slippages in that book could be higher because of exposures to certain sectors. But that being said, asset quality is not just one of the aspects of the credit metrics that we looked at. But especially when you look at the private banks, they're also very, very well capitalized. Their level of provision cover, specific provision cover on the NPLs, is also quite robust, as opposed to state banks wherein none of these things match up to what private banks had. Interestingly, you mentioned IOB. One of the things that as far as we don't rate that bank in publicly, but of course we do stress test across the banking across Indian banks, and one of the things that has been coming up. And we have been sort of highlighting that is that IOB among the mid-sized banks essentially has been looking quite vulnerable, and therefore it does not come as a surprise to us, given where its capital and asset quality is.
Okay, let me put it another way. We recently, I think a week ago, had a report from Credit Suisse which pointed out that actually the top 10 most leveraged groups to which banks have exposure have actually seen bank exposure increase. The amount of loans given to those leveraged groups has actually increased in the past 3 years. Then where is the confidence? If over-leveraged groups are only getting even more leveraged, then why are you, of the opinion that the pressure on banks will decrease?
Well, we're not saying that the pressure on banks will decrease. What we're seeing is what we're just saying is from the NPL perspective, there is likely to see one is likely to see some moderation on the stressed asset ratio for the system as a whole. But let's not forget that there's a huge stock of stressed assets that is already out there, and which will continue to have its share of impact on bank financials. As far as large credits are concerned, I think compared to 2 or 3 years back, today what we have the large, lender, basically large credit forum, and thereafter the joint lender forum. And some of these aspects obviously have increased the level of scrutiny, or so we hear from banks, from the RBI. So our sense is that while, yes, pressure points are there, but again, discretion along with regulatory scrutiny is a lot more higher now as what it used to be, say, 2 or 3 years back.
Okay. Are you also betting that the cyclical recovery is definitely there, and that is why you are expecting lesser and lesser stress?
At least, again, anecdotal evidence seems to suggest that clearly there are some signs of green shoots in certain sectors. But I guess it's hard to say whether the cyclical recovery has sort of embedded in itself in any solid way. I think what we're seeing is still the early signs of that inflection point. Hopefully, with the RBI rate cuts and most recently with the 50 basis point rate cut, some of that could see better traction, provided increasingly we see monetary transmission happening from banks. That has been sort of slow, and we know the reasons why. But I think all in all, clearly the direction is positive, and we just need to see probably that from a momentum perspective. Clearly, it's taking slightly longer than what we had initially expected.
Okay, Mr. Guha, what is your view on 525? Because a lot of the times we're seeing the gross NPL stabilize even without sale of loans to asset reconstruction companies, but there is that 525 picture of refinancing which banks report in the quarter and which doesn't necessarily go down well with the street. Do you consider it to be a part of your stressed asset book?
Well, again, I think 525 is a fairly a new concept, and we will see that increasingly getting applied this year, and as we've seen so far. So yes, I mean we try and factor it in some way, but clearly I think that is you could argue that could be a potential red herring, especially when banks don't follow it in terms of the laid out guidelines and do 525. The problem with that is, especially with 525, is that it will escape as performing. So there is no way it can actually get captured as a restructured asset unless the banks clearly lay that out in which accounts and how much amount. So there will always be a certain degree of ambiguity around 525. But yes, I mean we will or we are sort of looking at that as well.
Okay, you have lowered your current year NPL estimate to 10.9, or rather your stressed asset estimate to 10.9 from 11.1% last year.
Yeah.
Do you have a number for the year after, for FY17? Because you have a GDP forecast for FY17. So do you have a stressed asset forecast as well?
Yeah, I think we expect that to be in the range of, I think, 10.5 to 10.6, somewhere in that ballpark.
Okay. All right, we leave it on that note, Mr. Guha. Thanks very much for joining in and talking to us. So that's Fitch. In fact, some amount of an incremental positive which has come in from Moody's as well as from Fitch in 2 days. And Lata, to corroborate that, we had good numbers which came in from 2 PSU banks consecutively yesterday.
No, I would actually say 5. I would even include the State Bank babies. Well, good in the sense that they did not add to their slippages. The pace of slippages kind of decelerated, and the overall percentage of bad loans as a percentage of the total book fell or remained stable. So that looks like early good news seen along with what Fitch is saying. But let's wait and see. The big boys, PNB and BOB and BOI, have not yet reported numbers. State Bank has already probably proven its ability, but there are still a lot of very big numbers to come.
Yes, absolutely. We'll be waiting by for the whole week to address those numbers. Time for a break now.